Imagine a book so profound that even Warren Buffett read it twice. Yes, you heard it right, twice. This book, The Most Important Thing Illuminated, Uncommon Sense for the Thoughtful Investor by Howard Marks, is a beacon for every investor navigating the stormy seas of the financial world. It's not just a book, it's a compass, a guide, a mentor that breaks down the complex world of investing into digestible pieces. Brace yourself as we delve into the core principles of this game-changing book. Risk, a four-letter word that can either make you or break you in the investment world. Risk, at its core, is the potential to lose something of value. In the realm of investments, this is typically monetary value. However, with risk comes the potential for reward, a tantalizing prospect that can lead to significant financial gain. One of the most effective ways to mitigate risk is through diversification. This means spreading your investments across various assets rather than putting all your eggs in one basket. Diversification can help balance out losses in one area with gains in another, creating a more stable and potentially profitable investment portfolio. But how does one diversify effectively? One strategy is to invest in large-cap exchange-traded funds, or ETFs. These are investment funds traded on stock exchanges, much like individual stocks. Large-cap ETFs are composed of stocks from large companies with a market capitalization of $10 billion or more. These funds provide a broad exposure to different sectors of the economy, which can help reduce risk. However, it's crucial to remember that diversification isn't a guarantee against loss. It is a strategy to manage risk, not eliminate it. All investments come with some level of risk, and it's essential to understand and be comfortable with the level of risk you're taking on. In the world of investing, risk and reward are two sides of the same coin. You cannot have one without the other. The potential for higher returns comes with a higher risk, but also the potential for more significant losses. This is the delicate balance that every investor must navigate. The key is to find the right balance for you, one that aligns with your financial goals and risk tolerance. Remember, the higher the risk, the higher the potential return, but so is the potential loss. As the legendary investor Warren Buffett once said, risk comes from not knowing what you're doing. So, equip yourself with knowledge, diversify your investments, and tread the path of investment with caution and confidence. Investment isn't a straight path, it's a cycle. In fact, it's a series of cycles, and one of the most significant of these is the credit cycle. The credit cycle is a fundamental aspect of an economy's economic cycle. It involves a period of credit expansion or a boom, followed by a period of credit contraction or a bust. It's like a roller coaster, with its thrilling ascents and stomach-dropping descents. Now, during the boom phase, optimism runs high. Lenders are more willing to lend, and borrowers are eager to borrow. Credit is easy to come by. Businesses invest and expand and consumers spend. The economy grows. But here's the catch. This can't go on forever. As the saying goes, what goes up must come down. And when the down comes, it can be quite a fall. The bust phase kicks in, optimism turns to pessimism, lending tightens up, borrowing slows. Businesses contract or even go bankrupt, and consumers cut back on spending. The economy shrinks. This is the credit cycle in action, and it's a crucial concept for investors to grasp. Because understanding where we are in the credit cycle can help us make informed investment decisions. Now let's talk about the pendulum effect. Picture a pendulum swinging back and forth. On one side we have optimism, risk-taking, and high returns. On the other side we have pessimism, risk aversion, and low returns. The pendulum never stays in one place. It's always in motion, swinging from one extreme to the other. Investors too can behave like this pendulum. When times are good, they can become overly optimistic. They start taking on more risk in search of higher returns. But when times are bad, they swing to the other extreme. They become overly pessimistic, avoiding risk, and settling for lower returns. But here's the key. Just as the pendulum eventually reverses direction after reaching an extreme, so too do investment markets. And this is where the savvy investor can step in. By recognizing these extremes and anticipating the pendulum swing, they can position their investments to take advantage of these market shifts. So, what's the takeaway here? Investment isn't a straight path, it's a cycle. And within that cycle, the pendulum swings in both directions, success and failure. But as an investor, your job isn't to predict exactly when the pendulum will swing. Instead, it's to recognize when it's swung too far in one direction and is likely to start moving back. The pendulum swings in both directions, success and failure, so keep your eyes open. In the investment world, there's an ongoing battle between value and growth. Just like the age-old debate of the chicken and the egg, the clash between these two investing styles has been a topic of discussion for decades. Let's take a quick dive into these divergent investing philosophies. Value investing is a strategy that involves buying stocks that appear to be trading for less than their intrinsic or book value. Value investors actively seek shares of companies that they believe the market has undervalued. They believe the market overreacts to good and bad news, causing stock price movements that do not correspond to a company's long-term fundamentals. This overreaction gives the value investor an opportunity to profit when the price is deflated. On the other side of the ring, we have growth investing. This style involves investing in companies that exhibit signs of above-average growth, even if the share price appears expensive in terms of metrics such as price-to-earnings or price-to-book ratios. In other words, growth investors are more concerned with a company's potential for rapid expansion than its current value. So, which style comes out on top? Well, it's not as simple as picking a winner. Both styles have their merits and drawbacks. Value investing can be a safer route, as you're purchasing stocks at a discount. However, it requires patience and a good deal of analysis to ensure you're not buying a company that's cheap for a reason. Growth investing, meanwhile, can yield significant returns as you're buying into companies poised for expansion. But this style comes with its own set of risks. Growth stocks are often more volatile than their value counterparts, and if the anticipated growth doesn't materialize, you could be left holding the bag. But here's the key takeaway. It's not about choosing one style over the other. In fact, the most successful investors know how to balance both. They understand that there are times when value investing outperforms and periods when growth investing takes the lead. Warren Buffett, a well-known proponent of value investing, has been quoted saying, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Yet he's also invested in high-growth companies like Apple and Amazon. In reality, the battle between value and growth isn't about determining a winner. It's about understanding your own investing style, risk tolerance, and financial goals. It's about finding the right balance and sticking to your strategy, even when the market tides turn. So, whether you're a value investor, a growth investor, or a bit of both, remember this. The market will fluctuate, trends will come and go, but your investment philosophy should remain steadfast. Whether you're a value investor or a growth investor, the important thing is to stay true to your investment philosophy. Price is what you pay. Value is what you get. A simple yet profound statement that captures the essence of investing. To understand the relationship between price and value, let's consider an everyday scenario. Imagine you're at a fruit market. You see a basket of apples priced at $10. Now the price is clear. It's what you need to pay to acquire those apples. But the value, that's subjective. To someone who loves apples or needs them for a recipe, that basket might be worth well over $10. But to someone who's allergic to apples, the value might be zero. This same principle applies to investing. The price of a stock, bond, or any other security is what you pay. But the value is what you perceive it to be, based on your analysis and expectations. Now here's the tricky part. The market price is not always reflective of the true value of an investment. Sometimes the market overvalues a security, inflating its price beyond its true worth. Other times the market undervalues a security, offering it at a bargain. The trick to successful investing is to identify these discrepancies and act on them. This brings us to the importance of buying at the right price. The price you pay for an investment can significantly impact your potential return. If you buy a stock for $50 that you believe is worth $100, you stand to make a substantial profit if the market corrects itself. But if you buy the same stock for $90, your profit potential is significantly smaller. And yet, many investors get caught up in the excitement of a rising market and end up buying at inflated prices, only to suffer losses when the market corrects itself. This is where the concept of value investing comes in. Value investors seek out underpriced securities, buying them at a discount to their true value. But be warned, while buying at the right price can yield high returns, it's not without risks. Using leverage or borrowed money to buy more of an undervalued security can amplify your profits, but it can also magnify your losses. If the market doesn't correct itself as you expect, or if it takes longer than you can afford to wait, you could end up losing more than your initial investment. So, In the game of investing, it's not just about picking the right stocks or bonds. It's about understanding the relationship between price and value, and having the patience and discipline to wait for the right price. Remember, the key to successful investing is not just about choosing the right investment, but also about buying at the right price. In the investment world, there are two values that rule: alpha and beta. These are not just Greek alphabets, but significant indicators in the realm of investment. Let's begin with alpha. Alpha, in simple terms, is your personal investment skill. It's the ability to create performance despite market fluctuations. Think of it as the X factor that separates the exceptional investors from the average ones. It's the extra return your investment generates over a benchmark index or other comparable investment. If your portfolio has a positive alpha, congratulations, you're outperforming the market. But if it's negative, it might be time to reconsider your strategy. Now let's move on to beta. Beta is the sensitivity of a portfolio to the market. In essence, it's a measure of risk. A beta of 1 implies that your portfolio will move with the market. If it's more than 1, your portfolio is more volatile than the market. And if it's less than 1, it's less volatile. It's crucial to understand that a higher beta does not guarantee higher returns. It simply indicates higher risk. So, how do these two values come into play? Well, in the investment equation, Y represents reward and X represents market fluctuation. The equation is Y equals alpha plus beta times X. In this equation, alpha and beta work together to help you navigate through the turbulent seas of investment, steering your portfolio towards greater returns. In a nutshell, these two values are about balancing risk and reward. Alpha is about skill and outperformance, and beta is about understanding and managing risk. Together, they form the dynamic duo of investment strategy, each playing their part to maximize returns while minimizing risk. So as you venture into the investment world, always remember these two values. Understand them, utilize them. They could be the difference between a successful investment journey and a rocky one. Alpha and beta, two values, one goal: to maximize your returns. 14 minutes, countless insights, one book. We've journeyed through the core of investment risk, the cyclical nature of investments, the battle between value and growth investing, the crucial link between price and value, and the twin values of alpha and beta. This is just the tip of the iceberg. Dive deeper into Howard Marks's wisdom in The Most Important Thing Illuminated. Invest wisely, grow exponentially. Remember, the most important thing is to never stop learning.